Welcome to today's webinar on getting ready to file your taxes. We're just going to give a few minutes and then we'll go ahead and get started. So let's go ahead and get started. 2018 was an important year for individual and business taxpayers, most of whom had to adjust to big changes in the law. So today's webinar is intended to help you prepare your return in light of some of those changes. We'll talk to you today about the major changes in the tax code, walk through a few case studies showing their potential impact, and then open it up to a question and answer session. So let's get started. We'll begin with a question on everyone's mind. Will the new tax law lower or raise my tax bill? The answer is it depends. Some of the biggest factors that the answer depends on include whether you live in a state with high income and property taxes, how much income you earn, how much you contribute to charity, and whether you own a business. And for many taxpayers, the changes will be pulling on opposite ends of the rope, and it won't be possible to determine the net effect until your tax advisor runs the numbers for your situation. So for high net worth individuals, the following slides include most important changes to help you figure out whether the new rules are likely to raise or lower your tax liability. On your screen are a list of the changes to the tax code that could potentially mean a lower tax bill for you. A major change from tax reform was that all tax rates were reduced. Additionally, there was a sharp increase in the standard deduction. For tax years 2018 through 2025, the standard deduction will be $12,000 for single filers and $24,000 for married couples filing jointly. That's close to double the levels from 2017. Now on your screen are the changes to the tax code that could mean a higher tax liability. The new law caps deductions for state and local taxes to $10,000, the so-called SALT provision. It also eliminates the $4,050 personal exemption. Now let's dig a little deeper into two of the items highlighted on these two slides, tax rates and deductions. After that, we'll look at a few scenarios to determine what the recent tax changes mean for everyday Americans. As we mentioned, the new tax regime still features 7 tax brackets like previous years, but lowers a number of the tax rates. It also changes the income threshold at which rates apply. So let's take a look at the new rates and brackets. Tax reform also resets the tax brackets, setting a new income threshold and tax rates while retaining the total number of 7 brackets. The old brackets were 10%, 15%, 25%, 28%, 33%, 35%, and the top rate was 39.6%. The new brackets start also at 10%, but then are at 12%, 22%, 24%, 32%, 35%, and the tops bracket being 37%. It's worth remembering that the tax code is progressive. So your marginal tax rate is the top tax rate you pay, the rate you would pay on an additional dollar of income. But you'll generally pay taxes at a variety of rates, depending on your taxable income. So looking at the chart on your screen, a single filer with $85,000 in income would pay taxes at the 10% rate on the first $9,525. They would pay 12% on the income from $9,526 to $38,700, pay 22% on additional income up to $82,500, and have a marginal tax rate of 24%. Another big change was the capping or total elimination of deductions. Here are the highlights. The new tax code eliminates the personal and dependent exemptions for 2018, which were $4,050 in 2017. It also limits the amount of state and local property, income, and sales taxes that can be deducted to $10,000. In the past, these taxes have generally been fully tax deductible. And it also caps the amount of mortgage indebtedness on a new home purchase on which interest can be deducted to $750,000, which is down from $1 million in the current tax law. Prior to the passage of the new tax law, taxpayers were allowed a tax deduction for certain expenses known as miscellaneous itemized deductions. Miscellaneous itemized deductions included expenses such as fees for investment advice, IRA custodial fees, and accounting costs necessary to produce or collect taxable income. For tax years 2018 to 2025, these deductions have been eliminated. The new tax law also eliminates the tax penalty for not helping health insurance after December 31st, 2018. It also temporarily lowers the floor above which out-of-pocket medical expenses can be deducted from the current law floor of 10% to 7.5% for 2017 and 2018. So for 2018, you can deduct medical expenses that are more than 7.5% of your adjusted gross income as opposed to the higher 10%. Taken together, these changes will dramatically change the tax filing experience for many Americans. For some, it will simplify the process. Because the higher standard deduction will exceed the value of itemized deductions for many taxpayers, the Tax Policy Center estimates that more than 25 million families will stop itemizing in 2018. That's more than half the number of people who have itemized in recent years. So how do you know whether it will make sense for you to itemize? A general rule of thumb is to start with your tax returns for 2016 or 2017. If your situation is similar in 2018 and your itemized deductions fall below the new standard deduction, which is $12,000 for individuals and $24,000 for married filing jointly, you'll likely not itemize. If your total deductions exceed the new standard deduction, you'll need to consider the new rules for deductions. However, the total impact of the changes to rates and deductions will vary dramatically from one taxpayer to another. So we're going to go through a few simplified case studies that will show how some of these changes could play out. Of course, these are hypothetical, and it's important that you get an accurate sense of what the tax law means for you by consulting a tax professional. So let's take a look at the first case study. This is Layla and Sammy, retirees who live in a state with no income tax. They've paid off their home, and they have limited deductions. They pay taxes as married filing jointly and have been taking the standard deductions for a few years. Let's say that in both 2017 and 2018, they have income of $90,000 that they get from their pensions, a 401k, and the taxable portion of their Social Security. Their local property tax is $4,800, and their state sales taxes were $3,200. They also make charitable gifts of about $2,000. In 2017, their total itemized deductions would have been $10,000. So they would have opted for the standard deduction of $12,700. They would have also been entitled to personal exemptions of $8,100, leaving them with a taxable income of $69,200. That means in 2017, their federal tax bill would have been about $9,400. In 2018, they would still opt for the standard deductions because $24,000 would now be still greater than the $10,000 of their itemized deductions. But in 2018, there'd be no personal exemptions, but they'd still be better off with taxable income of just $66,000. So their federal tax bill for 2018 would be about $7,500. Let's look at another couple living in a state without income tax. We'll assume that their financial situation is the same in 2017 and 2018. They're married and they file jointly. They have $150,000 in income from their jobs and paid $9,000 in mortgage interest on a $350,000 loan. They also paid $4,500 in local taxes and about $9,000 in state sales tax. In 2017, their total itemized deductions exceeded the value of the standard deduction. Their total itemized deductions were $22,500 versus $12,700 for standard deduction, so it made sense that they itemized. They deducted the $22,500 from their income along with the $8,100 personal exemption, which left them with $119,400 in taxable income. That meant that their 2017 tax bill would have come out to be about $21,300. In 2018, their state and local tax deduction would have been limited to $10,000. So their total itemized deductions would consist of the $9,000 in mortgage interest and a maximum of $10,000 in state and local taxes, a total of $19,000. At the same time, the standard deduction rose to $24,000. So in 2018, they choose to take the standard deduction, reducing their taxable income to $126,000. Their 2018 tax bill would be about $19,600. And let's take a look at another hypothetical example. In this case, we'll again assume identical financial situations for 2017 and 2018 and no state income taxes. The couple is married filing jointly with income of $200,000 from jobs and investment interest, $10,000 a year in mortgage interest payments for their $500,000 home mortgage, $7,000 in property taxes, and another $5,000 in local income taxes. The couple also gives significantly to their local charities of about $10,000 per year. So in 2017, the couple's $32,000 in itemized deductions was greater than the standard deduction. After itemizing, they had a taxable income of $168,000 and a tax bill of about $34,000. The couple's itemized deductions will still exceed the standard deduction in 2018, even after the limit on state and local taxes reduces their total itemized deductions to $30,000. After deducting $30,000, the couple has taxable income of $170,000, higher than 2017, but new tax rates still lower their tax bill to about $29,379. Now that we've looked at the impact of the new tax code, let's discuss a few ways to possibly lower your tax bill. Be sure to take full advantage of tax-advantaged retirement savings vehicles like traditional IRAs and 401k accounts when appropriate. These plans allow you to contribute funds on a deductible, if you qualify, or pre-tax basis, which reduce your taxable income. Contribute the maximum allowed amount to all of your retirement accounts if possible. Contributions to a Roth IRA aren't deductible or made with pre-tax dollars. However, qualified Roth distributions are completely free from federal income tax, which can make these retirement savings vehicles extremely appealing. You can also consider whether it makes sense to convert a tax-deferred savings vehicle like a traditional IRA to a Roth IRA. When you convert a traditional IRA to a Roth IRA, the converted funds are generally subject to federal income tax in the year that you make the conversion. If a Roth conversion does make sense for you, you'll want to give some thought to the timing of the conversion. For example, if you'll be in a better tax situation this year than next, you might think about acting now rather than waiting. Keep in mind, depending on your situation, you can hold more than one retirement account at the same time. So for example, you may contribute the maximum amounts to your 401k and to a non-deductible traditional IRA as well. You may not get the deduction from your non-deductible IRA, but you can still convert it later to a Roth IRA and take advantage of tax-free growth and withdrawals at retirement age. If you're a business owner, you'll have even more flexibility and options at your disposal. So talk to your Azzad financial advisor to make sure you're taking advantage of them. Let's mention here that taxes can make a big difference to your bottom line. Let's assume two people have $5,000 to invest every year for a period of 30 years. One person invests in a tax-free account like a Roth that earns 6% per year, and the other person invests in a taxable account that also earns 6% each year. Assuming a tax rate of 28%, in 30 years the tax-free account will be worth $395,291, while the taxable account will be worth $295,896. That's a difference of $99,395. Now back to our tips. So make sure you also review the realized gains and losses in your taxable investment accounts before the end of the year. Specifically, look at your realized short-term and long-term transactions. Depending on your situation, your Azzad advisor can help you consider harvesting losses to reduce gains. This is a common technique used late in the tax year. It involves realizing losses to try to offset gains made throughout the year. Also remember that taxes are only one part of investing. You won't want to harvest losses in cases where it could potentially hurt your portfolio's growth potential. Since your advisor is a fiduciary, will also be mindful of your investments, so any tax harvesting is not done at the expense of your goals and risk tolerance. And lastly, if you are already charitably inclined, make sure you do it in a tax smart way. For example, if you're required to take minimum distributions from your retirement account because you're 70 and a half or older, and you're fortunate enough not to need this money, you could consider making a qualified charitable distribution from your IRA directly to a qualified charity. A qualified charitable distribution will satisfy your RMD requirement. And even better, this amount gets excluded from your taxable income. You can donate up to $100,000, but you must use a check writing privilege on your brokerage account so that your transfer is made directly from your retirement account to your charity. Make sure when doing a qualified charitable distribution for your required minimum distribution that you tell your accountant, since there's no special coding for them on Form 1099. There are other tax smart ways to donate to charity that can help reduce your tax bill. Talk to your advisor for more information. Your Azzad advisor can also help you avoid costly investment decisions that may subject you to a high tax bill. Sometimes what you read in a newsletter or watch in the media may not be a good idea for your specific situation. For example, some clients, it may make sense to convert their IRA into a Roth, and for others it won't. Your Azzad advisor will provide you advice that fits your situation versus a generic answer. And on that note, remember that if you have questions in general, it makes sense to work with a tax professional to see how the new tax regime may affect you, and whether there are strategies you should consider to help manage your tax situation going forward. Tax software may be appropriate for some people, but it isn't customized. This brings us to our question and answer period for today's webinar. Please use the chat box in the GoToWebinar control panel to send us your questions. So we have our first question. How can my Azzad advisor help me reduce the taxes on my investment account? Well, this can actually start when we start actually building your investment portfolio. We can build portfolios that have lower turnover for taxable accounts. As I also mentioned before, we can see the long-term and short-term potential tax consequences, and we can give you a snapshot of where you are throughout the year. So that means at the end of the year, we can harvest any losses, which again means selling stocks which have losses to offset those that have gains. And we are also fee-based, so you won't incur any additional commissions or trading fees for those trades like you might at other firms. We can also help you plan for a potential tax bill. So we have financial planning and plan charitable giving tools that can help find ways to help you save on taxes while still meeting your financial goals. There are tools like a donor-advised fund or a charitable lead trust, which can be good for fast-forwarding deductions and still help you meet your personal and charitable goals. Also, on another note, we can rebalance your accounts if you're feeling nervous about the markets, and then, of course, figure out the potential tax consequences of doing any of that rebalancing on a taxable investment account. So another question, how can my Azzad advisor help me reduce my taxes when I start making distributions for retirement? That's a really good question. Plus planning can actually start way before retirement when we talk about diversifying among different account types. That's why it's important as you're in your accumulation phase of investing and saving and putting money towards retirement, you consider taxable accounts, Roth accounts if possible, whether your income allows it or your 401k allows it, or again, you're just doing Roth conversions. And of course, traditional retirement accounts like pension plans, 401k plans, simple IRA plans, so on and so forth. Of course, if you're self-employed or you have your own business, we can help you with deciding what types of retirement plans would best fit your business situation, and we can help you analyze the costs and benefits of different types of retirement plans. And then also when it comes time for you to start taking mandatory distributions at the age of 70 and a half, we can discuss different options for you to satisfy that requirement, that required minimum distribution, without adding it to your income. And another question, do certain kinds of investments have different tax consequences? So yes, they can. One factor that can affect the taxes for a different investment is the portfolio's turnover, or how much a manager is buying and selling. Of course, anytime you make a sale, that's called a realized gain or loss, and that can affect your taxes. Also, some stocks which are income oriented and have higher dividend distributions may have different tax consequences than growth oriented stocks. And of course, while a lot of investors look at tax deductions primarily, it's really important that they not ignore the power of tax deferral. Again, like I mentioned, certain accounts like retirement accounts or Coverdell education savings accounts are tax deferred. And that can really help you grow wealth over time by protecting it from taxation. And for, again, small business owners, an Azzad advisor can help them maximize their retirement options with plans that can allow significant tax deductions and savings. And we also have some specialized tools for ultra high net worth families that can help maximize wealth and save on taxes. So there's another question here whether the about the Azzad portfolios and mutual funds. We definitely have all of our information available on our website. If you go to azzadfunds.com, you'll be able to find all of our offerings. We have two publicly available mutual funds, the Azzad Ethical Fund and the Azzad Wise Capital Fund. You'll be able to find the prospectus and fact sheets, which include the fees and the objectives of the fund, as well as additional portfolios offered through our separately managed accounts and through Azzad Ethical Wrap program. We have an additional 9 portfolios in various different asset classes. And again, all the information on those are also available through fact sheets on our website. Another question, I have a small business. Can you explain my maximum 401k? If I contribute to 401k as profit sharing, is that taxable on my personal return? I have no employees. For individuals who have their own business, especially those who don't have any employees, of course, whenever you're setting up any kind of self-employed retirement plan, you always have to look at the cost and benefit. The benefits certainly are the tax benefits. How much can you put aside towards your own retirement? Essentially, what are you able to pay your retired self now and save on taxes on, versus what is the cost that you will need to pay in administration and also to other employees that you have, because again, qualified plans require that they pass certain tests for fairness and discrimination, to make sure that, again, you're not setting up a plan that just benefits yourself and not your employees. So if you set up a plan, for example, that has a 401k, you can do what are called salary deferrals, which is the amount of money that you take from your own salary. Right now, the maximum for anyone under the age of 50 is $19,000, and there's an additional $5,000 catch up if you're over the age of 50, so that goes up to $24,000. On top of that, you can set up what are called profit sharing contributions. Again, a profit sharing contribution is now a contribution made as an employer. So this is, again, an employer expense. And so, again, that is a deductible expense. But again, it's another way that can help you maximize your total contributions towards your retirement. If you have employees, you'll need to consider, again, how much you'll need to provide them in profit sharing contributions. If you're self-employed, then, again, you don't need to worry about that, and you can typically maximize 401k profit sharing contributions. You can also add additional plans to that, like defined benefit plans, which can further maximize the contributions you put. And those are plans that are designed along with an actuary and are based on your age and salary. So definitely you can reach out to your Azzad advisor and they can help put a proposal together to see what type of plan or what combination of plans will really work best for you and your business. All right, it looks like We have one more question relating to HSAs. You can actually open an HSA through our transfer agent, Mutual Shareholder Services. Also, I would recommend that if you have an HSA, you can reach out to them and see if you can purchase the Azzad funds through your existing HSA, or your health. HSA stands for Health Savings Account. So other than that, it looks like there aren't any other questions. We truly appreciate you joining us for this important topic. Please, if there are any other questions that you might have, please feel free to contact us directly. Again, visit our website, azzadfunds.com. You can email us at info@azzadfunds.com as well. Thank you very much and have a nice day.